I have a question for you. Which of these two companies is more sustainable, Tesla or ExxonMobil? The answer may seem obvious, but the reality is that it depends on who you ask. Earlier this year, Tesla was booted from S&P Global's Sustainable Index Fund, while the oil giant ExxonMobil remained. The reasoning came back to three letters that many have heard, you've probably heard them, but few truly understand. ESG. They describe a burgeoning movement in the finance world towards a more sustainable, compassionate form of capitalism, ushered in by companies that prioritize three key issues: the environment, society, and corporate governance. Advocates argue that it's a win-win, that sustainable investing can help solve the defining issues of our time and bring profits while doing so. But whether ESG delivers or not is what we're going to explore in this video. And let me tell you, this rabbit hole goes deep. We'll start with a deceptively tricky question. What is ESG investing anyway? Before we get into it, I want to tell you about our channel. Here at Capital.com, we make explainer videos about investing and economics, giving you the insights you need to understand what's going on in the markets and to make informed trading decisions. We're also a trading platform ourselves, so you can make trades right on our website or using our app. After this, you might want to check out our film exploring how high interest rates could go. It's an interesting one. But now, back to ESG.
ESG investing has seen rapid growth.
ESG, however.
You'll come across these three letters alongside index and mutual funds, in earnings calls, and financial papers. And in my research, I came across one name again and again: Tarek Fancy. He's a busy guy.
Joining us now is Tarek Fancy.
We've seen the last few years ESG words.
But he made some time to speak with me.
I tend to be pretty critical. I do think there's a way to fix the space, but I think, we're early in that process.
Tarek was the chief investment officer for sustainable investing at BlackRock, the biggest asset manager in the world, with $10 trillion under management. He left in 2019 after becoming disillusioned with what he sees as a well-meaning but broken system.
I think over time I started to realize that the majority of the work we were doing had no real-world impact.
Tarek's time at BlackRock coincided with a booming period for ESG, which has been on the rise for years. The number of sustainable funds on offer nearly doubled from 2015 to 2020. And as of last year, sustainable assets totaled over $35 trillion globally. It's more than a third of all financial assets. But for something so popular, ESG is notoriously difficult to define. There's a lot of confusion. So that seems like a good place to start. What is ESG? First, let's demystify those letters, Sesame Street style. E is for environment. That refers to a company's emissions, pollution, energy usage, and so on, stuff like that. S is for social. For this one, think people. Treatment of employees and suppliers, working conditions, access to healthcare, you get it. And G stands for governance, specifically corporate governance. Is the company managed with transparency and integrity? Is there equal opportunity and diversity at the top? How much does the CEO get paid? That kind of thing. The thinking goes that if we can identify those companies that benefit society and reward the good ones with capital taken from the bad ones, then the world becomes a better place. That's the big idea anyway. The core mandate here is to broaden the idea of what a company is for. The influential economist Milton Friedman wrote that companies have no higher purpose than maximizing profits for shareholders. This has been the prevailing wisdom for decades. It's known as shareholder primacy, or the Friedman doctrine, and it drives boardroom decision-making the world over. But today, a vocal chorus of critics beg to differ from Mr. Friedman. And that chorus includes many of today's most prominent CEOs. In 2019, nearly 200 of them signed a statement redefining the role of a corporation as being for the benefit of all stakeholders, including customers, suppliers, and communities at large. That statement marked a monumental, if only symbolic, shift in corporate thinking and blew wind in the sails of sustainable investing and ESG.
ESG to an investor is an additional data set. The idea is that these are non-financial indicators that do eventually have some material impact on your bottom line.
So instead of just reading quarterly reports to gauge a company's profitability, looking at earnings per share and balance sheets, sustainable investors attempt to wrangle a broader range of metrics concerning the company's behavior, essentially trying to quantify a company's impact on the world and then reward the good ones with more capital. Here's where I encountered a common misconception about ESG, something I didn't really understand at first. Tarek explained it to me.
People believe the average ESG score, it's measuring if that company is good or bad for the world. The bizarre thing is that in reality, that's not what they're measuring. They're measuring the implications of ESG related considerations and factors on your bottom line.
In other words, ESG isn't just about positive impact. It's first and foremost a risk management tool. So instead of just assessing the risk the company poses to society, ratings tend to focus on the risk that ESG factors pose to the company. For example, a heavy emitter isn't just bad for the environment, it's also prone to penalizing regulations or carbon taxes, which could affect its bottom line. The job of grading how good or bad companies are falls to ESG ratings firms. They assess a company's performance on a laundry list of metrics and spit out something like an ethical credit score, often a number between 0 and 100 or a letter grade, AAA, BB, so on. And it turns out doing this is easier said than done. There are dozens of these ratings firms and about as many different ways of scoring. And herein lies the rub. Because there is no standardized approach, ESG ratings are inconsistent and often seemingly inexplicable. In fact, while credit scores agree around 99% of the time, ESG scores between 6 of the biggest ratings agencies only correlate a little more than half the time. But why? Well, for one thing, ratings agencies are measuring different metrics in different ways and interpreting those results differently. But ratings firms encounter one other glaring problem at the heart of this whole thing: a lack of information.
The data has not been as good as it needs to be. It's getting better. That's useful. But there are certain areas that are very difficult to measure, and that probably won't change anytime soon.
Yeah, some ESG metrics are easier to obtain and measure than others. E is the easiest to quantify, at least in theory. The big one is obviously carbon emissions and pollution.
Do not let our planet die!
Although the question here is one of scope. Where do you stop measuring? Does a car manufacturer count the emissions of their suppliers? What about tailpipe pollution once the car leaves the factory? It gets a bit tricky. But that aside, the vast majority of publicly traded companies around the world don't disclose their emissions. They don't have to, and doing so is complicated and expensive. S and G can be measured in some clear ways, such as turnover, fatality rates, diversity and tax transparency, a few others, but these leave more room for interpretation.
For social characteristics, quite difficult. Like, how do you measure culture? How do you measure a whole set of things that almost certainly would likely be important to a business, but are not as easily measurable?
The lack of information and standardization have led to yet another problem biting at the heels of ESG's rise: greenwashing. Authorities are starting to crack down on dubious claims about ESG credentials that might be more hype than truth. Financial authorities in the US and Europe have proposed regulation targeting greenwashing and some of the inconsistencies at the heart of measuring ESG. For example, the SEC is considering a requirement for companies to disclose emissions, and for fund managers to be more transparent about the thinking behind their funds. But as it stands, there's little regulation or enforcement in the sustainable investing space. As obscure as they seem, these indicators are the basis for ESG funds, like indexes, mutual, or pension funds. Fund managers use these scores to curate a basket of green or socially responsible equities. They label them and then they put them on the market, and boy do they sell. The surge in attention and demand for these sustainable funds means that firms can charge a premium in fees, and they do. Up to 40% higher fees than traditional funds, making ESG a lucrative venture for asset managers. But what about investors? Is it lucrative for them? That really depends on who you ask.
The promise of ESG at its core was meant to be that it's good for investment returns, it's good for the planet, so it's a win-win, and a third win, that it's good for asset managers because they get more in fees. Unfortunately, the first few years of ESG have shown us it's really only the third one that's happening. It's very difficult to make money and save the world at the same time.
Yeah, this is a matter of debate. The financial performance of ESG has a mixed record, and in many ways, it's a classic case of too soon to tell. Many studies do show that, on average, ESG funds actually do outperform the market, or deliver alpha, as a cool Wall Street type might say. But others dispute the claim as oversimplified, or confusing correlation with causation. ESG funds did generally outperform from 2010 to 2020, but they also tend to be jammed full of tech stocks, a sector which enjoyed a booming decade and a rough last year or so, along with ESG funds. So at least for now, the jury is out on this one, folks. ESG may or may not deliver higher returns, but does it deliver on its core mandate of making the world a better place? Of course, it may be too soon to tell. But to get close to an answer, we need to talk about two diverging strategies behind sustainable investing: divestment and active engagement. Divestment is quite simple. Take funds away from bad companies and reallocate those funds toward good companies. The thinking is that if enough people divest from, say, fossil fuel companies, it'll punish them by raising their so-called cost of capital. That means that the sell-off should push down their share price, making it more expensive for them to raise money in the future.
The question there is, are you deciding that you don't want to partake because you think it's wrong, or do you actually want to stop it from happening? Divestment allows you to not partake. Divestment doesn't achieve the second one, which is stopping that from happening in the world, because all that happens is you sell the shares. By definition, for you to sell them, someone else has to buy them.
In practice, it's unclear whether this actually works, and there's conjecture among economists that divestment doesn't have a big impact on corporate behavior.
Divestment is kind of a bit of a lost cause. I call it cancel culture meets financial markets.
So let's look at another strategy then: active engagement.
Where you say, actually, I'm going to stay owning this thing, and because I own it, now I have shares, and I can vote those shares and influence the direction of the company. That's better than divestment, because you have a seat at the table.
Yeah, you can try to steer the ship. But as Tarek explains, the limits with active engagement get at the core tension behind sustainable investing, where doing the right thing collides with maximizing profits.
And that's where engagement actually runs into a wall. You can't really engage and use voting to get a company to change their behavior when their core business model harms society because of the limits of fiduciary duty.
That's the legal obligation to behave responsibly with somebody else's money, to act in their best interest, which generally means maximizing returns.
Someone else is spending your money, then they're subject to a legal obligation that they have to focus on value, measured in dollars, not values.
So where does this leave us? What's the verdict on ESG? The issues we've discussed here reveal a broken system in need of repair, but not a valueless system. As Tarek helped me understand, the core problem here is not a lack of good intentions, it's a problem of incentive.
And I stress the only way you can actually change the financial system in a significant and meaningful way is changing the behavior of the participants. The only way you change the behavior of the participants is through changing their incentives, right? If they make more or less money doing certain things, if the law comes along and makes things, more or less profitable.
In the face of fiduciary duty, advocates for ESG call for a duty to one another, to our communities, and to the planet. But that may not occur without a drastic reformation of the calculus behind business decision-making, which in Tarek's view may require robust regulation.
Stakeholder capitalism is a great idea, but I would argue that it needs to be based on mandatory rather than voluntary compliance if we're to avoid hitting major tipping points and seeing extreme environmental depletion. The way to think about ESG is that there are the ingredients and then what they're being combined into. The ingredients are actually pretty good. The challenge is today they're being combined into products that imply real-world impact that doesn't exist. It's a dangerous placebo that harms the public interest because it convinces us that we can maintain the status quo for longer, even though that's definitely not the case.
Thanks so much for watching. I hope you found this informative and interesting. I know I did. There's a lot more to this topic than we can fit in one film, so there's some further reading in the description if you want to know more. Next up, you might want to watch this film about private debt. Hit like and subscribe and stay tuned for more films like this in the future. and I'll see you next time.